Howdy, Jacob here. Today we're looking at the company Tenaris in the energy equipment and services industry with 21 billion market cap. They produce and sell seamless and welded steel tubular products and related services for oil and gas industry. Founded in 2001 based in Luxembourg. Super low price earnings right now, it looks like, but if you do just a quick analysis and look at their earnings per share, we see that it is by far the highest it's ever been in the last 10 years. And so, although the P looks very low now, we do see that that's based on the market cap and the earnings amount, and that earnings amount is the highest it's ever been, which is going to make that number look very small. But if we average it out, it might not be as cheap as what it looks like. But that's why we're doing our analysis. Return on invested capital is very high recently, but has averaged out in the upper single digits. Dividend hasn't grown really at all, but not terribly concerned about that. I do get a little bit concerned when companies pay a dividend that looks pretty substantial from history. Although in the last year, it's 1/6 of their earnings per share. If you look at the average, it's a pretty volatile business with negative dollar earnings per share, negative 14 cents, as low as 10 cents a share. So it is tough when companies do that. Obviously, they can dig into their cash reserves for a little bit, but that's why a company needs cash reserves, especially a cyclical company that pays a dividend out. So let's look at that balance sheet. 1.6 billion cash on hand, 1.9 billion short-term investments, with 21 million short-term debt, 48 million long-term debt. We're very safe here. Their interest-bearing debt is very low, and so they have a lot more cash on hand than interest-bearing debt. Very safe from that perspective. Their cash flow recently, again, shows very hefty production free cash flow. Their acquisitions are somewhat there. There was a pretty big acquisition over here of $1 billion in 2020. Outside of that, just pretty small net acquisitions. Capital expenditures down quite a bit from over here. Looks like they sold off a division here, $314 million worth of devastation, and that minimized their capital expenditures. So that's a positive sign. Or that can be if it's at the detriment of growth. Then obviously it's not. Not everything is so black and white. There's always a gray area to everything. But it looks like here it did hinder their cash from operations a little bit, but it's a safer. Their free cash flow production is still very similar. So to have lower capex in relation to their free cash flow is a positive. Their debt has been paying down, and like I said, they have very little debt now. So hopefully they can really focus on making the company more efficient through acquisitions that are really driving up those margins, not just increasing revenue, buying back shares that are stupendously cheap. This dividend is paying out $637 million in aggregate. On a 5-year average basis, it's looking like maybe 50% of their free cash flow. It is 3% yield. So pretty good yield there, well above market average. Let's start making some assumptions here. So pretty wild return business. 10 billion revenue in 2014, down to 4.2 billion in 2016. Grew a little bit to 2021, and then explosive growth here. I will probably dampen the growth a little bit. Let's go down to 3%. Let's assume a 13p in price for cash flow at the end of 7 years, saying that their growth is going to be slightly. Their growth is and moat status and everything are going to be slightly lower than the market average, which from a cyclical business, people love investing in companies they know what they're going to do. And so I think that you have to actually dampen their terminal value based on the fact that it's a pretty cyclical business. And for margins, do pretty close to average here. Let's do 14, 16, a little bit of a range. 13, 16, a little bit of a range there. Share change. They bought back a little bit of shares recently, but not enough historically for me to be confident that they're really going to. And the dividend, they've been increasing that recently, but it is pretty similar to what it's been in the past. And with the cyclicality of the business, I'll probably keep it there. So this is saying on a 5-year average basis, about 50% of their cash is going towards a dividend. Their remaining is going to be split between hopefully buying back cheap shares. I don't have that currently here, but that might be offset a little bit due to stock-based compensation, making acquisitions that make sense, and reinvesting back in themselves because they don't have a lot of debt to pay down at this point anymore. So I guess I will change one thing. So they've historically bought back $214 million worth of shares at least just the last year. I will actually say, let's say that they use a little bit of that free cash flow, maybe just 15% to buy back shares due to the fact that they have been buying back debt the last couple of years, and now they don't have any more to pay down, or they don't have a lot to pay down, 21 million, 48 million, and they produce $1.5 billion in free cash flow. So I think I'm comfortable with this. So about 50% payout to dividend, maybe 10 to 15% to share purchases, and the remaining 35% to acquisition reinvestment. I think that to me makes a good amount of sense. And we're honestly not terribly far off from the price point that I got to. So this could be something that I do more research on in the near future. I hope you enjoy the video. Have a great day. Thank you.